Should you be buying in Melbourne right now? Will it boom and when will it boom? In this episode, we'll cover about 10 charts to explain through different analyses the answer to exactly that question. Everyone has an opinion on Melbourne. A lot of people are flocking to it, thinking it's the next Perth, the next Brisbane, the next Townsville. Let's see if they are right or wrong.
Welcome to the Oz Property Investment Mastery Podcast. My name's PK and I help busy people build passive income by buying top 5% growth and cash flow property and build a portfolio using data without wasting months doing research, spending weekends at inspection or catching flights, or dropping $10,000 to $20,000 on buyer's agents every single time. So if you're confused, lack confidence, and just overwhelmed with all the information and marketing misinformation available online and don't know where to start, then this show is for you.
If you're thinking, God, I wish I invested in Perth in 2021, God, I wish I invested in Adelaide in 2019, in Bendigo in 2016, or Geelong in 2016, or Brisbane in 2021, or Townsville in 2022, the list goes on. You might be in luck. This might be the 2021 of Perth, but for Melbourne. But let's see if that's really the case, or whether this is just a massive case of FOMO. The first place we have to start for this analysis is the baseline. Let's understand how much Melbourne has actually grown since 2015. Now, of course, different cities have their own cycles, so whether we start this index at 2015 or 14, 17, 16, it all has its limitations, but we've got to draw a line in the sand somewhere. What's really interesting, I think might surprise some of you, is that since 2015, Melbourne has actually grown more than Perth. So a lot of you might be thinking out there, Melbourne has really underperformed in the last few years. Surely there's time for another boom on the horizon. But if we just take a step back, see the forest from the trees, we start to understand that actually Perth, despite its massive boom recently, has actually grown less than Melbourne since 2015. Of course, Darwin has been a perennial underperformer. No one expects Darwin to boom for no reason, and we shouldn't have the same school of thought for Melbourne either. Perth is only up about 40% since 2015. Melbourne is up about 50% since 2015, and other cities like Canberra, Adelaide, Sydney, even Brisbane are up around 60%, with Hobart, actually the outperformer, up at about 80% since 2015. So that should give you some context of just how much value there is or isn't in Melbourne right now. And to further give you confidence of whether this is the right time to buy in Melbourne or not, let's look at this long view analysis, compounded annual growth rate from 1986 to 2021, and yield of select international cities. So if we look at places like Sydney, Melbourne, and Brisbane, we tend to find that compared to their international peers, their yield is kind of low, like around 3 or 4%. Brisbane is, of course, better than Melbourne, and Melbourne's slightly better than Sydney. But they've grown more at around 7 to 8% every year over the last 20, 30, 40 years, compared to places like San Francisco and Geneva, which have similar yields. Other cities around the world like Boston, Austin, Atlanta, Dallas, New York, Houston, Chicago don't grow as much. They grow at less than 5% per year, but yield almost double or more than double. The closest comparison to our Australian cities is Brussels in Belgium, of course, where it's grown at about 7% every year, but yields even poorly at around 2%. So Australian real estate is really a capital growth play, not a yield play. Now, of course, this chart doesn't show you many other locations across Australia, including large regional centres, which over the same period, 30, 40, 50 years, have grown just as much as Sydney or Melbourne, if not more, but with twice, sometimes 3 times the yield. So the takeaway is, if you're going to buy in Melbourne, if you're going to buy there now, you're going to have to cop a pretty poor yield. But historically, the capital growth has been good. But we need to understand whether that's going to be the case going forward or not. So this is a really cool chart by FinAnalytics Financial, and what they've done is per capital city, including Melbourne, they've said typically how much more expensive or cheaper is it than the average of all capital cities over a 10-year period. And this is really revealing because over the long term, Australian real estate reverts to the mean. In other words, if something becomes really cheap relative to its average long term, then it starts to catch up and vice versa. So by this, we understand Melbourne, which is in the blue, it's starting to look very cheap. Typically, it is about 5% more expensive than the capital city average in terms of median house prices in Australia. 5% more expensive. Of course, Sydney is the most expensive, then it's Melbourne, and the others are cheaper. So it makes sense. It's one of the more expensive ones. But what we're seeing right now since December 2021 is that the real price in Melbourne has actually gone down well below its 5% premium. Right now, it is actually cheaper than the average capital city in Australia. What this tells us is that over the long term, there needs to be some catch up at play unless you believe that Melbourne is structurally different to how it was in the last 10 years. Looking at other capital cities, Sydney is typically around 29% more expensive than the average capital city, and right now it's smack back on that. So it's at about its right value play. It's not too expensive, it's not too cheap. We're not likely to see huge price falls nor price gains in Sydney. Brisbane is very revealing. Typically, it's about 18 or 19% cheaper than the average capital city price. Right now, it's the exact same as Melbourne. It's about, let's call it about 5% cheaper than the average capital city price. So from this metric perspective, it would be seen to be a little bit overvalued. Another one that is a little bit overvalued is Adelaide, according to this metric, and it's typically about 29, 28% cheaper than the average capital city. Right now, it's only about 12% cheaper than the average capital city. And then lastly, Perth is typically about 19% cheaper than the average capital city. And right now, it's more than 20% cheaper. So despite the 70, 80% gains that we've seen just over the last few years, it's still showing value. The reversion to mean is a real thing. Of course, you have to believe that the last 10 years were a good indicator. If you do believe that, you would say that there's a lot of value right now in Melbourne. And one of the reasons there is so much value in Melbourne, according to SGS Economics and Planning, is that in 2021, right smack bang in the middle of COVID, we saw Greater Melbourne exude or release the most amount of population. Greater Melbourne saw almost 60,000 people leave its borders, its boundaries, its perimeters in 2021. No other capital city saw this mass emigration apart from perhaps a little bit of Greater Sydney, but that was less than 5,000. So this is one of the reasons that Melbourne house prices are so low compared to what they ought to be, is because people left in droves. In fact, they're still leaving on the Gold Coast. There's still people coming in from Sydney and predominantly Melbourne, really creating a floor and extending the boom that the Gold Coast has experienced over many years now. You can see how Melbourne was a complete anomaly in its mass population emigration in this time period and versus every other location in Australia. So the population leakage has really hurt Melbourne, but let's see what it's likely to do going forward. From the National Forecasting Program with Data Wrapper, we can understand an estimate of the future population growth in each state for the next 25 years out to 2046. Now, of course, this is at a state level, it's not at a city level, but you can use it as a proxy to understand what Melbourne's likely to do in terms of population growth and therefore house prices. So population in New South Wales is likely to grow by 30% in the next 25 years. In Victoria, it's 41%, okay, so more than New South Wales. In Queensland, it's 38%, so between New South Wales and Victoria. In WA, it's 44%, so this is the highest, okay, it's even more than Victoria and New South Wales. South Australia is 24%, so not as big as these other locations, and then Tasmania is only 8%. So what this tells me, I mean, start with Tassie, right, is that sure, there's always markets within markets, but by and large, it's unlikely to have as much of a jet engine on its back in terms of population and house price growth than perhaps some of these other areas. And it tells me that Victoria is in fact a genuine candidate for big house price growth going forward. Now, of course, this is only demand. We have to look at the supply side as well, many other factors, but it starts to paint a multi-dimensional picture for you to make up your own mind what's going to happen. Now, at this stage, I think it's very important to say that a lot of people thought that and still think that since COVID, everything's gone up everywhere. There's no need for science, there's no need for analysis, there's no need for data to make property location selection decisions. But this really couldn't be further from the truth. Every time I post a client deal, people say, oh, why are you celebrating 200K in 1 year? Why are you celebrating 50% growth in 2 years? What's your course all about? Anyone could have achieved this blindfolded on because of COVID. But check this out. National percentage of suburbs in quarterly decline. Of course, in the start of 2021, you almost could have put a blindfold on, right? Almost could have done that because you can see basically every suburb across Australia was growing. But fast forward to when interest rates started going up in middle of 2022, we saw that almost 80% of suburbs were actually declining. So for those of you who think time in the market is the only important thing, well, that's half true, but timing the market is just important. You need to get both of those right to fast track your retirement ASAP through the vehicle of property investment. And lately, this figure, although went down again, has gone back up to about 30%. I think the number of suburbs in decline may continue to go up, so it's back into old pre-COVID times when some of us who have been around for a longer time, we know that it's always a case of markets within markets. You need to look at data, and I think this is exactly the case in Melbourne as well. I'm going to take you through a few more charts, but right now I can share that clients have started buying in about 6 Melbourne suburbs, not units, not in the west. There's a lot of supply on the east and the far north and also the west parts of Melbourne. You have to avoid them, but you can still get properties under 700K with a yield of more than 4.5%. If you're looking for a yield of more than 6%, Melbourne's not the right one for you, nor should you be attracted to units because there's a big supply pipeline of units coming in Melbourne. You don't want to be caught with your pants down when the tide goes out. Melbourne's going to be a mixed bag. Some people will buy there, perhaps watching this video and lose money. Some people will buy there, perhaps watching this video with more conviction in their data-driven approach and actually make money. It's not going to be like Perth in 2021 when I was shouting from the rooftops about it, but hardly anyone was listening. Certainly the buyer's agents were saying PK was wrong. But I think what it will take for Melbourne to boom is genuinely that interest rates will need to come down, not just by 25 basis points, not just by 50 basis points, but a decent 75 to 125 basis points will create enough of a surge in borrowing capacity, elevation, will create enough of a surge in confidence in the economy. Remember, consumer confidence has been under 100 points since 3-4 years. We need to get that confidence up. We need to get money flowing around in the economy again for people to have the confidence and literally the spending power to be able to buy in Melbourne en masse. Now, I'm not saying that's a good thing. Of course, there's still inflation to be cautious of, but that's what it's going to take, in my mind, for a capital city-wide boom in Melbourne. But I don't see that coming anytime soon, and therefore I don't see a Melbourne boom willy-nilly across the board coming anytime soon. And the reason is that our government, our amazing government here in Australia, is doing the complete opposite of what the RBA needs to happen to bring inflation down, to be able to cut the rates as much as what I've just mentioned. Look at this. Government spending as a share of nominal GDP is at the highest it's ever been outside of COVID lockdown circumstances. It's well above 15% of nominal GDP. What's been happening is that the RBA is trying to contract the economy to bring down inflation. Meanwhile, the Labour government, perhaps it's to catch votes, perhaps it's to do something else, has been pumping the economy completely at odds with our overall outcomes. In fact, Westpac just did a research paper on this, which was published by the AFR. State spending splurge could delay interest rates, warns Westpac. And they're saying that federal and state governments are planning to inject more than $50 billion of stimulus into the economy in the year ahead, adding to inflation pressures and the risk of interest rates cuts being delayed. That's what Westpac is saying. In the context of basically every other country having tamed inflation, dropping rates, including the Fed last week, why is Australia the black sheep? Why is Australia the only one still struggling with inflation? You have to lay the blame on the government. Check this out. Just in 2025, a whole percentage point of GDP is going to be contributed by the Labour government's budget stimulus initiatives. This is completely at odds with what the RBA is trying to achieve. It never used to be like this. In 2024, the budget was set, so it was actually contractionary. It took money out of the economy to bring inflation down. Now they're putting it back in because you know what's going to happen next year, right? There's a federal election around the corner. And the state governments in total are at the highest level of debt that they've ever seen, 800 billion. And guess what? Victoria is the highest. It's got the highest growth in state debt out of any other state. The Victorian government, the Victorian budget is so weak that a lot of the infrastructure projects promised are now being pared back. You already saw the Commonwealth Games were cancelled. They're probably going to cancel a whole lot of other initiatives as well. The state government is really in a pickle there. On one hand, they're giving out so much money to various initiatives in order to gain popularity. But on the other hand, they have this massive debt, and then they're penalizing property owners by huge land tax and other disincentives. So this creates a perfect storm where Victoria is unlikely to be the most healthy state economically for at least the next 5 years. They have this big debt that they have on their shoulders that they need to get rid of. Yes, long-term population is rising. Yes, there's a lot of value at play right now in the housing market in Melbourne. The housing markets don't just rise because it's time for them to rise. There needs to be some stimulus. There needs to be some trigger. Just like Brisbane was basically flat for the last decade, 2010 to 2020, there needed to be something to spark it into life. The longer there isn't any spark, the more value potential there will be, and therefore the larger the boom will be at that later point. Is this the right time to buy in Melbourne? Yes, if you can afford the yield and you know exactly which of the half a dozen or suburbs that are the best pickings, like my clients are buying in, that have select appropriate strategies. But if you go into Melbourne right now, you could be in for 3 years of subpar growth, a property costing you $10,000 to $50,000 a year in negative gearing, negative cash flow. Sure, you might have a huge boom that you'll benefit from in 3 or 4 years' time, but in the meantime, why not invest elsewhere and get the best of both worlds? I hope you enjoyed this analysis. Of course, there's so many more data points at a macro, micro, LGA, SA3 suburb level that I teach my clients, and they're really important to make confident decisions with conviction. Of course, the red herring is that if there's a new state government, the balance of power goes away from the incumbent government, then the land taxes and all the penalties investors have been facing may be abated, and therefore that may see a rush of sentiment into Victoria, into Melbourne. That could spark a boom faster than what I predict. Sometimes enough of a self-fulfilling prophecy causes something to boom, but I don't think my YouTube channel is enough to do that, nor do I want it to boom, to be honest. I think we need healthy, sustainable, long-term growth, not at 30% per annum like Perth almost, but at a gradual, shallower pace. I hope that continues in Melbourne. Hopefully that brought you value. My name's PK, and I'll see you in the next one. Thanks, guys.